Doing your own bookkeeping? Well, don't make these mistakes. As business accountants, my team and I spend all day long helping business owners on their journey, and particularly our bookkeeping team here, they see the same sort of common mistakes happening again and again. And one of the reasons why I wanted to do a video on this is to help you avoid those, give you that knowledge and just that moment to think, actually, yes, I've heard Dan talk about this. This is maybe something that I should be aware of. Now, the obvious thing about getting the bookkeeping wrong is that your tax bill could potentially be wrong. You could either be paying too much or you could be paying too little. If you've heard me speak on the subject before, you'd have heard me say a million times, good records equals paying the right amount of tax, which generally equals paying a lower amount of tax than you might otherwise. So real good records is key. Now, as bookkeeping, the other thing that could go wrong if you do get those bookkeeping entries wrong and that tax bill is wrong is there is penalties involved potentially. HMRC, the tax people, do charge penalties for inaccuracies regardless of whether they're deliberate. The penalties just get deeper, so you want to avoid those. But more importantly than that, forget all of that kind of stuff. More importantly for you, if you're an ambitious owner and you want to grow your business, you're going to need to have good numbers and good information to base those business decisions on. You know, only so much of it can be done at a gut level, and there is a big bit of that, but a lot of it needs to be planned in terms of what you're going to do. You know, when you want to hire that first person, how do you know? How much profit are you actually making? Unless you've got these figures and you've got regularly, you're just not going to know. So let's make sure that bookkeeping's right. So let's get on with it. But before we do, if you like these type of videos, make sure to click the subscribe button below so you get notified whenever we release more just like it. So before we get into it, in this video, I'm mainly going to be talking about the use of software apps. So your Xeros, your QuickBooks, your free agents of the world. But many of the concepts I'm going to talk about, these errors can and do occur inside of spreadsheet records as well. So mistake number one, and that's the obvious one in which somebody has entered the receipt incorrectly. So you've got, I don't know, a piece of stationery for £30 and you've ended up keying it as 35 or something like that, or 305, or as some electronic software I've seen, there's some amazing apps you can get where you can snap and get a picture there and it will read things like dates and amounts and will attempt to categorize it to save you some time. Now, if you're using these kind of things, it's just the same as you manually doing it. It's just that the computer is, in theory, going to get that accuracy right. However, I've seen one the other day for an Asda receipt for £17 million because it couldn't read the decimal point. But humans, so both humans and robots do make this mistake. But for obvious reasons, there's going to be an error there. Now, the reason that's so important if you're using accounting software is when it comes in, quite often the way these softwares work is you'll have your bank account connected and it will look for, let's say you spent £30 in Office Depot, it will look for a receipt that you've put in the system for £30 for Office Depot and say, hey, you know, do these two match? Would you like to pay that bill off with this statement line that we've got this transaction? And then you click OK and it's beautiful and it all works. And if you've ever seen any adverts for accounting software, they're the kind of ones they're going to show you. But if you've keyed that receipt in as £305 rather than £35 and as a payment for £35, they're not going to match. And you might then deal with this on your bank and say, okay, that was for stationery. So it's entered it in your books for stationery, but you've also entered a receipt for stationery here. And that kind of thing can happen in a spreadsheet as well. So really do make sure that those values are correct. And obviously, if you're VAT registered, you could potentially be claiming double the VAT or the wrong amounts of VAT. So that's a big and kind of obvious point one. So the next one would be, if you've got a team of people that you're paying, is we see mistakes with the way wages are dealt with. And it could be that you're actually a limited company and you're dealing with your own wages, or you're a sole trader and you're dealing with your own wages, and that's another mistake I'm going to talk about in a minute. But let's just say you're paying a team at the moment. One of the most common mistakes is there are different elements that need to be dealt with. If you imagine, if you paid somebody £2,000 a month, they don't get £2,000 into their physical bank. There's £2,000, then the tax people have had their tax and the national insurance off it, and maybe you've had to contribute to their pension, maybe they've had some student loan deducted, maybe they've had some pension deducted, and they get the little bit that's left at the end, you know, might be, let's say they've had a really hard month and there's only £1,000 out of that £2,000 that actually goes into their bank. What we see from a bookkeeping point of view is people will just put that £1,000 direct to wages. Now, that's not true. If you brought your report up and looked at your profit and loss, you're now looking like you've made more money than you actually have, because you only got £1,000 instead of £2,000 as your wages expense. It's too long to deal with in this video of how you would deal with that, but let's just say if you look for the function for journal, there's quite often a way you would deal with that with a journal and different what they call control accounts, where you send it to different places. You send all those elements to kind of different places and it builds up. It's one of the more complicated parts of bookkeeping, so bear that in mind. But just know that if you're deducting tax and national insurance, there's likely that if you're not sending it into multiple places, you're probably making an error. Now, while we're on the subject of wages, if you're a limited company and you're paying yourself, or you're a owner of a sole trader business, quite often with a sole trader business, you'd be looking to put your wages to owner's drawings, or if you're a limited company director, you might want to be putting it to something like director's loan account, or it might actually be some salary, and then you would put it to wages. But what we see far too often is everything just going straight to wages. So you'll see dividend payments in wages, you'll see owner's drawings in wages. They're not wages, that's referring to wages that go through the payroll system. So if you're a sole trader, that's normally for employees. If you're a limited company, there might only be a small proportion of your director's salary, if any, that's going to wages. Now, if you put those through to wages, what's going to happen is it's going to reduce your profits on paper, and incorrectly, you're going to massively reduce your tax bill. And we've seen multiple times over the years where people have then had a revenue investigation where they're like, aha, you said you declared wages, but at our back end, it says that you didn't have a wage payroll system that could have even paid these wages. So can we have a look at your tax return, please? So yeah, if you're doing that, make sure you segregate those correctly. And as I say, if you haven't got owner's drawings or director's loans or dividends paid set up, normally with drawings and dividends, they're what they call an equity account. You can normally choose that as like equity, and it will put it into the right place for you. So that's the top three. So number 4 would then be entering high value items that are going to last for more than a year incorrectly. So sometimes what we'll see is somebody will go they might have bought a new MacBook for £2,500 and they've put it straight to their profit and loss, some expense for computer, expensed equipment or something like that. It depends on what the category is called on their software, and they've put it straight there. And of course, if you imagine if you bought that MacBook in that month and you ran the report, it's going to make it look like you made no money because you spent all this money. Let's just say you're a one-person consultant and you had a quiet month. That could even put you in a loss. It's not true, because that MacBook is going to last you many years. So it should actually be put to what they call an asset item. Quite often in the software, there will actually be a default one for computer equipment, but you're just looking to make sure it's an asset one. And there's also another one called plant and machinery pool, where people will often put it in there. And if you do put it in there, just make sure you make a little note in the description, and you'll be able to remember later when you're doing your tax return what that was all about. Or if you have an accountant helping you, they're going to love you for the extra effort. So do that. And also this one goes the other way around as well. Sometimes we've seen people put very low values into plant and machinery because technically it's going to last a couple of years. But I would suggest that it's not a hard and fast rule, and lots of people use different amounts. But if you think a couple of £100 or more is quite a common value that we see people consider whether they should be going into sort of a small expense item, or whether they should be moved into the kind of that plant and machinery big stuff pile. But it really is a judgment call. But if it's like £25, nobody cares. It's going to go as an expense. Now, mistake number 5, and I'm going to give you a bonus 6th one because I think it's really important in a moment. But number 5, I'm going to talk to you about checking your accounts payable and accounts receivable report. Now, they're accounting terms. I apologize for it, but that is what they are called inside many of these softwares. And what it does, it gives you a list. So an accounts payable is a list of who you owe money to. So it's like, okay, here we go. It's all my suppliers. So let's say you're an electrician. It's going to give you all the people that you owe money to. And how old those debts are. So a lot of bigger businesses will use that to decide who they're going to pay today if they're on sort of credit terms where they're paying people maybe 30 days later. Now, we see so often that what will happen on here is you'll have negative figures. So it looks like they owe you money back, which is not normally the case. You'll also see stuff on there that's years old, because it's like, well, where's that been paid? And that is your number one check to make sure that you sort of sanitize that. Because it should be a snapshot of your business. You should be able to look at that and say, yeah, I owe these people that money right now. And if you don't, then you need to do something about it. So for example, you might have a fuel receipt on there for 3 years ago. And the reason it's there is because actually you put your hand in your own pocket and paid for it cash. You've not marked it in your software. So those kind of things. And sometimes you might look in there, dig a bit deeper and look at it and say, actually, oh look, that fuel receipt's unpaid for £30 in 2019, but I have actually got another receipt on the system for 2019 for exactly the same date for the same amount, and you can kind of spot that it's a duplicate, which is very, very, very common. So do check that report, your accounts receivable report, and just think, do I owe these people that money? If not, you got some homework to do. And the same thing with the accounts receivable report, and that's money that you are owed as a business. So you've raised some invoices, and sometimes again we see minuses. It's like, well, you don't owe that money back to the customer, right? And the client will say, no, of course not. Well, where did this come from? And you have a look in. Sometimes it'll be a missing invoice or something like that. So there's a lot of things. But yeah, those 2 reports, really, really important. Now, I didn't say to you I would give you a bonus 6th one because I think it's so important. And that's the absolute basic kind of standpoint is, Inside of these software programs, they have an amazing feature with this bank feed. The bank feed comes in, but those feeds do break on occasion. They do drop off if you don't refresh them. At the time of recording the video, they're hoping to move that. And what happens is the bank balance can be wrong. So periodically, especially at the year end before you submit any figures, if you're, say, a sole trader looking to do your own tax return, make sure that the figure that says your bank statement matches your actual physical bank statement. One of the ways I like to do it is I like to bring up what's called a balance sheet report, put the date to whatever date that you're looking to, and look at that balance in the balance sheet. Does that match your statement? If it doesn't, again, it's going to take me years and years and years probably to explain the different things it could be in a video, but for you, you've got some work to be doing. So that's it. And if you are watching this and think, do you know what, I've made those mistakes, I'd love to hear from you. Let us know in the comments below, and we'll see you in the next one.